How's it going, everyone? Today we're going to talk about 2023 global outlook. Now, this is completely from Blackrock, okay? So, one of the largest asset management firms in the world. And in fact, they're one of the financial overlords of a great part of the investment finance world. So, they released their 2023 global outlook and their financial new investment playbook. So let's see what is in it. So according to BlackRock, the global economy has entered a phase of elevated volatility. It's just now entered that phase, apparently. And that recession is imminent due to central banks' aggressive boosting borrowing costs to tame inflation. So they're saying that higher interest rates are actually really bad for the future, for the global outlook. But their actions, according to BlackRock strategists, will ignite the actions of central banks. Raising interest rates will ignite more market turbulence than ever before. So the BlackRock team writes in their 2023 global outlook that the global economy has already exited the 4-decade period of stable growth and stable inflation growth, okay? It's now entered the period of the highest instability. But what's kind of their point? Their point is that recession is foretold as central banks race to try to tame inflation. So recession, they're saying recession in 2023 is coming. The world's largest investment manager, they basically have gone all in talking about this global recession. What worked in the past to try to tame this essentially hyperinflation is not going to work this time, but what will work is a global recession. And that's kind of spooky, I think, right? So a deep recession, according to the report, is what's going to take to tame this kind of hyperinflation that is getting a stronghold all over the world. Now, let's take a look at this chart that they provide. It says taming inflation, okay, would take a deep recession. Okay, the U.S. GDP and potential supply 2017 to 2025. So they're in this chart, they're suggesting that a 2% fall, okay, a large drop in GDP is needed to close the gap between the demand and the supply. Okay, and that's for 2023. Now, that sounds kind of crazy to me because what that's going to do, a massive drop in GDP, is basically drive the average person into an economic despair. Essentially, they're gonna be very, very unhappy economically, financially. It's terrible. And again, they even highlight here in the chart, they're saying getting inflation all the way down to target, the dotted green line, would require the Fed to deal a significant blow to the economy. Essentially, they're slashing everyone's financial health. I mean, it's already slashed as it is. So imagine a 2% drop in GDP. Imagine the blow to the average person's financial well-being. The next thing they go on to talk about, the initial sharp drop was driven, of course, by the C-19 shutdowns. Okay, many lost their jobs, didn't look for another one, or started getting the government handouts. So some of that drop in the workforce has now turned around. But the yellow line shows that the part not made up is almost entirely down to aging. That's interesting. The increased share of the population that is of retirement age rather than pandemic-specific effects. That's why they don't expect an improvement in the participation rate from here on out in the future. And so no material easing of the worker shortage that is contributing to inflation. Anyway, so let's see the chart here. Workforce not recovered. They attribute it to aging. Contribution of aging to the U.S. labor force participation rate drop. Interesting. Now, whether you agree with this stuff or not, that's not the point. The point is to see how these so-called financial overlords, financial masters, actually see things. And that's, I think, very critical to your own personal management of preparedness for whatever financial calamity they're predicting. So the chart takeaway, labor force participation Rate fell dramatically during C19 as the economy shut down. And they're saying many people left, and because of aging, they're never coming back. Okay, that does make sense if they're advising the government to keep borders open. Cheap labor, massive influx of people, consumers, more consumers. I'll leave it at that. Again, agree with it or not, that's not the point. The point is to see how the rationale of these financial masters. According to Blackrock, we have entered into a new world order, okay? We see geopolitical cooperation, globalization evolving into a fragmented world with competing blocks, of course. You got BRICS, Russia, China, etc. And we got the West. They further write, geopolitical fragmentation is likely to foster a permanent risk premium across asset classes rather than have only a fleeting effect on markets as in the past. And that makes a lot of sense. So here in this chart, geopolitical risk grabs market attention, okay? Blackrock risk indicator. So this chart basically, they're saying that the risk is higher. We've seen a surge in market interest in geopolitical risk in recent months, highlighting the fraught environment. Of course, that makes sense. Russia invasion of Ukraine, obviously more risk and definitely big problems. So this chart is interesting. They're saying that the damage is already clear, that there's nothing to hide. So they're saying that the slide in housing sales, right, this year alone has already been steeper than previous Fed hiking cycles. So to them, they're already seeing the damage done and what the implications of this is. So looking at the chart again, we can see that here, such as in the 70s, 80s, that in 2022, the slope and decline is way sharper. It's a nosedive actually compared to the 70s, 80s, and even the early or mid 2000s. So it's pretty interesting chart. And in this chart here, they're talking about faster transition, policy helping accelerate the transition. This is part of the ESG movement, total annual green investment. Now, they love this because they're kind of pushing for it. And as you can see, 2030, they're saying that in US $1 trillion, this is a massive amount of policy will be pushing for these transitional investments. So global investment in the net zero transition is set to step up notably in the coming years, largely thanks to key policy action. Okay, these are political actions, and they're not market actions. They're not natural, capitalistic, organic. Okay, these are policy action. And because they're policy action, that means that it's done on purpose so that certain people can maximize their own profits. That's what I don't like about it. They even have here in quotes, we find good opportunities by getting ahead of where the green investments are going. Granted, if you check out the lithium markets, they're massively exploding. And part of it is these green investment pushes, okay? Whether political or whether it's just Tesla buying up lithium. I mean, it's pretty amazing stuff. And this one's interesting. They're talking about the investment gap, long view on infrastructure, okay? Infrastructure investment. And of course, part of that is green energy and net zero compliance. So if look at the current pace, 80 trillion, and in their estimates, they're saying projected need is 95 trillion. Okay, that's a lot. That's 15 trillion more than the projected need for 2040. And in their own words, the chart takeaway, structural trends, the reshaping global energy supply, digitalization and decarbonization entail a sizable step up in the pace of infrastructure investments. Now, what's interesting is that they're kind of saying you don't necessarily need to invest in green energy or ESG or net zero kind of investments. The asset selection class, essentially. So they're saying that for strategic investors, that an asset class, right, such as infrastructure, could actually provide a way to play into the trends. And of course, there's a lot of infrastructure that will be needed for sort of green investments, ESG, and all that jazz. Now here they go into different countries, okay? Tactical, granular views. Now, if you go down to the United States, it says it's at -1, the view, we are underweight. They say the Fed is set to raise rates into restrictive territory, okay? Economically restrictive, of course. People can't get loans. That's a problem for growing economies. Earnings downgrades are starting, but don't yet reflect the coming recession. Big deal coming out of Blackrock. For Europe, they say they're underweight, the energy price shock, of course, and policy tightening raise stagflation risks. If anything, they're already in stagflation, right? So pretty interesting stuff, whether you agree with it or not. That's not the point. The point is to be aware, okay? Financial education, of course. But anyways, that's it for now, guys. Thanks for watching. Smash a like, please subscribe, and I'll see you in the next one.
Can anybody out there hear me? Hear me?